It has been called the greatest city on earth, a global financial hub, a cultural powerhouse, a place where fortunes are made and, sometimes, quietly destroyed. For generations, owning property in London was considered the closest thing the British public had to a guaranteed investment. Safe as houses, people said, and when they said it, they meant London houses. But in 2026, something has changed. The numbers are in, and they tell a story that even 5 years ago would have seemed almost unthinkable. London, the city that never loses, is losing. And the question every property investor, homeowner, and first-time buyer needs to answer right now is this: is this a correction? Or is something far deeper going on? Let's start with the facts, because the facts are stark. According to the UK government's House Price Index, published in May 2026, London house prices have now fallen for 7 consecutive months year on year. The average London property sits at approximately £542,000, down roughly £18,000 from a year ago. That might not sound catastrophic in isolation, but the detail behind that headline figure is where things get genuinely alarming. Look at the borough-level data, and the picture becomes brutal. Westminster, home to Mayfair, Knightsbridge, Marylebone, and some of the most coveted addresses on the planet, has seen average prices fall 27% from their 2023 peak, according to Land Registry data. That is not a typo. 27%. In Westminster, Kensington and Chelsea, the most expensive local authority area in the entire United Kingdom, has seen average prices drop 20% from recent highs. The average flat there, once commanding close to £1.2 million, is now selling for under £950,000. Hammersmith and Fulham has fared no better. Average flat prices there have collapsed by 17%, sliding from nearly £700,000 to around £575,000. And it is not just price falls. The City of London and Kensington and Chelsea are both registering year-on-year declines of over 11% at time of recording. Westminster is down 12% year-on-year. These are not peripheral, struggling parts of the capital. These are its crown jewels, and they are correcting in a way that many analysts are only now beginning to fully reckon with. Barrett Kupelian, chief economist at PwC, perhaps put it best when he said the UK housing market is no longer moving as one country, but as two. The stark divergence between London and the south versus the rest of the country is now defining the entire landscape. To understand what is happening in London's property market in 2026, you have to understand that this is not a single-cause crisis. It is a perfect storm, and every element of that storm has been building for years. Force 1. The stamp duty squeeze. The first force is stamp duty, and in London this is particularly punishing. When stamp duty thresholds fell back in March 2025, London bore the brunt more than anywhere else in the country, simply because London prices are so much higher. The higher the property price, the greater the stamp duty liability. And when you are talking about a flat in Westminster at £800,000, buyers are staring down enormous transaction costs before a single removal van is booked. Stacey Eden, an analyst at RSM, confirmed as much. London's house market is especially exposed to stamp duty because of the capital's typically high house prices. The cost of getting in and of getting out has become a psychological barrier that is keeping buyers on the sidelines. Force 2. The end of the non-dom regime. The second force is one that was largely political in origin, but has had devastating consequences for prime central London. The abolition of the non-domicile tax regime has chilled overseas investor appetite considerably. For decades, ultra-high net worth individuals, from the Gulf states, from Russia, from Asia, were drawn to London's prime property market partly because of the tax advantages it offered to those not domiciled in the UK for tax purposes. That advantage has now gone. The result? A quiet but significant withdrawal of foreign capital from exactly the kind of luxury properties that make up Westminster and Kensington. When that demand evaporates, prices follow. Force 3. The Iran conflict and mortgage rate shock. The third force arrived suddenly and with devastating effect. When US and Israeli forces struck Iran on the 28th of February 2026, the ripples hit the UK mortgage market within days. Swap rates, the mechanism through which global events translate into borrowing costs, surged. Banks and building societies withdrew over 1,500 mortgage products in under a fortnight. Two-year fixed mortgage rates, which had been sitting at around 4.8%, climbed rapidly towards 5.5%. By May 2026, the average two-year fixed mortgage rate stood at 5.75%. RICS member Tarrant Parsons described what happened plainly. What had been a cautiously improving picture for activity has been knocked off course by the wider macro fallout from the Middle East conflict. With average fixed rates climbing back above 5%, it is unsurprising that buyer demand has softened. The Bank of England, which had been widely expected to cut rates in the spring of 2026, held at 3.75% at its April decision, and, with inflation climbing back towards 3.3% on the back of energy price spikes, the prospect of meaningful rate cuts this year has all but collapsed. Higher mortgage rates mean lower buying power. It is as simple and as brutal as that. Force 4. The leasehold and service charge crisis. The fourth force is structural, and it goes to the heart of what the London property market actually sells. A huge proportion of London's housing stock, particularly in the inner boroughs, is made up of leasehold flats. And leasehold flats are in serious trouble. Service charges across England have increased by an average of 41% between 2019 and 2024, according to the Property Institute. The average leaseholder is now paying £3,634 a year in service charges, a figure that has forced many would-be buyers to simply walk away from the leasehold market entirely. Then there is the cladding crisis, which continues to cast a long shadow. Many London flat owners are still locked in buildings they cannot sell, waiting for remediation work that has been years in coming. The result is visible in the data. Average London flat prices have fallen more than 7% since the start of 2023. In Hammersmith and Fulham, in 2025, 2/3 of all flat owners who had previously bought new-build properties sold at a loss. Analysis by Hamptons showed that roughly 2 in every 5 owners who had bought a new-build flat anywhere in the capital in the past 20 years sold for a loss in 2025. That is a staggering indictment of a market that was once considered infallible. Force 5. The EPC liability ticking clock. The fifth force is less immediately visible but increasingly impossible to ignore. Landlords across the UK face an obligation to ensure their properties meet an EPCC rating by 2030. In London, where the housing stock is older and the proportion of energy-inefficient properties is high, this represents a significant liability. Access Legal's Transaction Stress Rating Index, which analysed 161 local authorities, specifically flagged that prime London boroughs face a highly fragile combination of massive price expectation gaps and high volumes of Band D to G homes triggering potentially late-stage renegotiations. In plain English, buyers are increasingly factoring in the cost of energy efficiency upgrades when making offers, and sellers who have not done so are getting caught off guard at the point of exchange. Let us zoom out for a moment and look at what this adds up to across the market as a whole. Access Legal's comprehensive analysis of asking prices versus sold prices covering September to November 2025, found a median price gap of -22% between initial listing prices and final land registry completions. That is sellers accepting, on average, 22% below what they originally asked for. In the City of Westminster, the gap between asking price and agreed sale figure stands at a jaw-dropping 52% below original listing price. In Lambeth, it is also 52%. These are not outliers in struggling secondary markets. These are central London boroughs. Meanwhile, the wider picture nationally shows a market of two distinct halves. Rightmove data from June 2026 revealed asking prices fell by 0.6% in a single month, the biggest June drop in 14 years. New buyer inquiries tracked by RICS remained deeply negative, with a net balance score of -34% in May. Sales agreed were down 37% on a net balance basis. And yet, and this is the crucial counterpoint, the rest of the UK tells a completely different story. While London suffers, the rest of England, Scotland and Wales is, in many cases, thriving. Average house prices in England as a whole increased by 3.9% in the 12 months to April 2026. Wales saw a rise of 3.5%. Scotland grew by 2.8%. The north of England and Scotland are leading the charge, with Motherwell, Glasgow and Paisley among Zoopla's top-ranked markets for 2026. In the most affordable parts of the country, areas where average prices sit below £225,000, demand is surging. Pendle in Lancashire has seen prices rise 8.4%. South Tyneside is up 7.7%. Northern Ireland recorded a remarkable 9.5% year-on-year increase in the first quarter of 2026 tax, the best performing region in the UK. Even within London itself, the story is not universally grim. Elizabeth Line corridors, Woolwich, Abbey Wood, Ealing Broadway have seen price growth of between 7% and 9% annually, significantly outperforming the London average. Outer boroughs like Havering, Waltham Forest and Lewisham reached all-time high average prices recently, driven by relatively stronger affordability. The divergence within London mirrors the divergence within the UK. It is not that London is broken, it is that specific segments of London, prime central, new build flats, leasehold properties, are carrying enormous risk. And the investors most exposed are those who bought in those segments at or near the peak. Kevin Shaw at Property Service Group LRG framed this well. The point isn't that one part of England is winning. It's that markets move to different rhythms. Many northern markets haven't been on the same roller coaster as parts of the south. Property prices often rise in a steadier way in the good years, so they tend to fall less when sentiment turns. So where does this leave us? Is London in the grip of a temporary correction, a painful but ultimately transient adjustment, or is something more structural happening? The honest answer is probably both. Knight Frank has forecast that London house prices will fall by approximately 2% this year across the prime market, revised downward from an earlier forecast of flat growth. They do, however, expect cumulative London growth of 13.6% between 2026 and 2030. The long-term fundamentals, a world-class city with chronic housing undersupply, strong employment, and extraordinary international appeal, have not disappeared. Tom Bill, head of UK residential research at Knight Frank, described London as a two-speed market. Prime areas hit hard by taxes and political risk, while more affordable outer boroughs remain comparatively resilient. Winkworth describes 2026 as a potential return to a more balanced, functional London property market. A phrase that, depending on your perspective, is either reassuring or deeply euphemistic. But here is the critical insight from the data that the optimists must also grapple with. London is facing a supply crisis that runs in both directions simultaneously. On the one hand, new housing starts have fallen so sharply that, according to Knight Frank, London is likely to face one of its most supply-constrained markets of the past decade by the late 2020s. That should support prices over the medium term. On the other hand, a glut of new-build flats in the near term, particularly in the inner city in Sanch, is depressing valuations precisely where sellers are most exposed. Let us get practical, because whether you are a homeowner, a landlord, a first-time buyer or an investor, the London property picture of 2026 requires a very clear-eyed, borough-by-borough, property-type-by-property type analysis. If you own a prime central London property, if you own in Westminster, Kensington and Chelsea, or Hammersmith and Fulham, you are in the eye of the storm. A 20 to 27% decline from peak is not a paper loss you can ignore. Deciding whether to hold or sell is genuinely difficult, and the answer depends heavily on your mortgage position, your time horizon, and your rental income, if applicable. If your property is mortgage-free and you have a 5 to 10-year outlook, the long-term case for holding is reasonable. Knight Frank's 13.6% cumulative growth forecast for 2026 to 2030 suggests recovery is possible. But it will not be quick, and it will not be linear. If you are carrying significant debt, particularly at current mortgage rates above 5.75%, the arithmetic deserves very careful scrutiny. If you own a London leasehold flat, this is the single most exposed category of asset in the UK property market right now. New build leasehold flats in inner London have proven to be wealth destroyers for a generation of buyers. Service charge inflation, cladding liabilities, and the structural preference shift towards houses means that leasehold flat values, particularly new build face a prolonged headwind. If your lease is below 90 years, the urgency to extend is now a matter of financial survival, not just good housekeeping. If you are a buy-to-let investor in London, the picture is nuanced. On the positive side, average private rents in London sit at approximately £2,280 per month. And while rental inflation has cooled compared to its recent highs, the absolute rental income remains substantial. Demand continues to significantly exceed supply in the rental market. However, the Renters' Rights Act, which came into effect on May 1, 2026, has materially changed the risk calculus for landlords. The Act raises risks around repossessing or selling properties, setting rents, and guaranteeing rental income. Combined with the forthcoming EPCC requirement by 2030, which, in the words of Paragon Bank's head of mortgages, Louisa Sedgwick, is going to be bigger and potentially more demanding than the Renters' Rights Act because of the infrastructure required to deliver it, landlords need to be stress testing their portfolios seriously. If you are a first-time buyer, considering London, here is something the doom and gloom narrative tends to miss. For a genuine first-time buyer with a 5-year plus horizon, 2026 might represent a rare window. Prices are lower than they were. Stock levels are higher than they have been in years. Rightmove data shows that correctly priced properties are selling in 36 days versus 127 days for overpriced ones, meaning the market is efficient, not dead. For the right property, in the right location, at the right price, there are opportunities. Focus on outer London boroughs with strong Elizabeth line connectivity. Houses over flats. Freehold over leasehold wherever financially possible. Before we conclude, there is one wildcard that deserves its own moment. The geopolitical situation in the Middle East remains fluid, and its impact on UK mortgage rates has been more significant than many anticipated at the start of 2026. If the conflict de-escalates, swap rates could fall, mortgage products could return to more competitive levels, and the demand side of the London market could revive relatively quickly. There is also the political dimension. The Conservative Party, currently in opposition, has floated scrapping stamp duty entirely as a policy platform. If political momentum builds around transaction tax reform ahead of the next election, even without an immediate change in government, the expectation of reform could itself stimulate activity. Policy expectations in property markets can move prices just as surely as the policies themselves. And then there is what PwC's Kupelian described, cautiously, as a possible catalyst for a bounce back. The potential repatriation of British nationals from the Middle East, the return to office trend pulling workers back to the capital, and the simple, unavoidable reality that London's chronic undersupply of housing means that any sustained return of demand will collide with a wall of constrained supply. London has been written off before. It bounced back after the financial crisis. It bounced back after Brexit uncertainty. The city's structural advantages, its labour market, its cultural and educational institutions, its international connectivity, have not been eroded. They are temporarily obscured by a set of powerful but ultimately cyclical headwinds. So where does UK Property Compass point in June 2026? London is the biggest risk in the UK property market this year. The data on that point is unambiguous. 7 consecutive months of annual price falls, double-digit declines in its most prestigious boroughs, a leasehold flat market that has destroyed wealth for a generation of buyers, an EPC liability ticking away, mortgage rates that have reversed the year's optimism, a buyer cohort sitting firmly on its hands. But risk is not the same as irredeemable failure. Risk means uncertainty. Risk means volatility. Risk means that the same market which punishes the impatient and the over-leveraged can reward the informed, the long-term thinker, and the disciplined buyer. The UK property market in 2026 is not one market. It never has been. It is hundreds of micro-markets layered on top of each other, some falling, some soaring, most somewhere in between. If you are invested in prime central London leasehold flats with an expensive mortgage and a short time horizon, 2026 is genuinely dangerous for you. If you are a patient investor with equity, a long-term view, and the ability to identify quality assets in well-connected outer boroughs, or indeed to look north, where Pendle, South Tyneside, Glasgow, and Northern Ireland are generating returns that London has not seen in years, then 2026 is a market with opportunity buried within the alarm. The compass does not tell you where to go. It tells you where you are. And right now, in London's property market, you need to know exactly where you stand. Stay informed, stay disciplined, and we will see you in the next episode of UK Property Compass.